The fundamental price of gold is a great metric to predict whether the gold price is going to go up or down. In this video, I'm going to show you how to calculate this fundamental price of gold. On this chart, you can see the gold price in yellow. It's currently at $3,300 per ounce. The fundamental price of gold is at $3,900 per ounce. So you can see there is an upside of 20%. So if you can calculate this chart, you can actually predict where the gold price will go to. So this is a very important and useful metric. Okay, so this is the formula. The fundamental price of gold is the spot price times 1 plus the risk-free rate minus the gold yield. Let's look at all of these parameters. The risk-free rate is the yield on a safe asset like a US Treasury note. You can find this online, very easy. Currently, it's at 4% per annum. Okay. The gold yield is a more difficult parameter, and this is approximated by the co-basis. And what is co-basis? A co-basis is the following formula: the spot price minus the futures price divided by the futures price. And it expresses the profitability of a D-carry trade, which is selling at spot and buying in the future. Okay, a bit difficult to understand, but you can see it as the following. If the co-basis is positive, okay, then you have a profitable D-carry trade, and that typically happens during a backwardated gold futures curve. So where the gold price is currently 3,300 and in the future it's lower at, for example, 3,000. So if you sell it at spot at 3,000, you can buy it back at, at spot 3,300. You can buy it back at the lower price at 3,000, and you have a positive co-basis. So spot is 3,300 minus 3,000 divided by 3,000. That's a positive number. So you are making money with a D-carry trade. Conversely, today we have not a backwardated gold chart. We have a contango gold futures curve. So the spot bid price is 3,300 currently, and the futures is 3,500. So you have a negative number. So you are unprofitable in your D-carry trade. Okay, so this is the co-basis, which is the same as the gold yield. And we input all these numbers and we find the fundamental price of gold. There's a note here. The fundamental price of gold also has physical supply, demand, inflation, currency, strength parameters, but we will just use part of it, the co-basis and the interest rate, just to make it a bit easier to calculate. Okay, so the first parameter, risk-free rate, you can just find it online, 4.35%, and input this number. Easy. The second parameter, co-basis, as I said, this is the spot price minus futures price divided by the futures price. So this is the spot price, 3,300 currently. We have contango, which means the gold price goes up in the future. This is the futures price, 3,500. So 3,300 minus 3,500 divided by 3,500. This is a negative co-basis, so you cannot make money like this for a D-carry trade. So just calculate this number like this, 3,300 minus 3,500 divided by 3,500, you get minus 5.7%. That's the gold yield number. Okay. Let's recapitulate all the parameters. So the spot price of gold is 3,300 currently. Futures price 3,500. Core basis, we calculated it at minus 5.7%. Risk-free rate is just the 3-month treasury bill at 4.3%. Gold yield is the same as core basis, so we can calculate the fundamental price as this formula. Okay, 3,300 times 1 plus risk-free rate, 4.3%, minus 5.7%, which is actually a plus then. And then we get 3,630 as our fundamental gold price. Okay, that's about 10% higher than today. So that means gold will go up. Now, some sensitivity analysis on this formula. If you have a steeper gold curve, if this curve, for example, here, it was not that steep, it was flat last year. But as time progressed, it starts to get steeper and steeper. You can see this on this curve. If you have a steeper gold curve, that means that the core basis will go more negative. So this parameter goes more negative, which means the minus goes more positive. So your fundamental price will go up when the futures curve gets more into contango. Okay, that's the first thing. Always look at the futures curve. If it gets steeper, that means the fundamental price will probably go higher. So you want to see this curve go up and steeper. Okay, so and then the second parameter, the risk-free rate. If the interest rates go up, that means that fundamental price will also go up. That's easier. If this goes up, then this will also go up. So if you see that the Fed is going to hike rates to 5%, 6%, and the gold price, the spot gold price doesn't go down and stays the same, then the fundamental price will go up higher and higher. Okay, if this is the same and this goes up with higher interest rates, then this here, fundamental price will go up as well. What does this mean? That means that there is inflation. If the interest rate goes up, that means that there is inflation in the system and the Fed needs to hike rates. Okay, so it all pans out. If we have inflation, the fundamental price of gold goes up. If we have more storage costs, the futures curve will go up, and that also means that the fundamental price will go up. Okay, so basically we have shown you how to calculate the fundamental price of gold. You can try it yourself and see what you come up with. And as long as this is positive, then gold will go up. Okay. Why am I doing this? Because now you can find this chart at Monetary Metals, but one day this website will be gone, and then you will need to do it yourself. Okay, so I'm teaching you how to do this yourself, because one day you can't rely anymore on this nice website. They update it, I think, every day, so you can look at it. But one day it's gone, and then you need to do it yourself. Okay, so another great tool to predict gold prices.